All right. You're welcome again. So tonight we're going to be discussing trading breakouts and fake outs. Trading breakouts and fake outs. So like I said in the caption of the flyer that I dropped in the group, understanding breakouts and fake outs is a very important component of trading, very important, right? Because most of the time, what happens in the market, like I said in previous classes, is that we follow the trend. We look at the trend. The first thing we do whenever we come into the market is we identify the trend. Okay, what's the trend? Where's the market trending towards? Is it an uptrend? Is it a downtrend, or is it a sideways trend? That's the first thing we want to identify. All right. So there are several methods of identifying that. We want to make sure, first of all, we get the trend right, because the trend, they say, is your friend, right? And I've always said before that what we do in the market is we follow the money. We follow the flow of the money, right? We follow the money flow. We are the small traders. We are the retail traders. What we are doing is we're following institutional money. We are following where the money is flowing towards, right? If you look at the market this evening and look at certain pairs, you will see certain massive movements which happened from a news event that happened by 4 p.m. Nigerian time, right? Just happened, I think, probably 3 hours ago, right? So that happened, and that was an event from the U.S. Economy, consumer confidence, right? The consumer confidence came out lower than expected, so the dollar index trended down, right? Currently, you see that move coming down. Now, what's happening when you see a news event comes out and then you see price move massively in a particular direction? That's the money flow for that direction. Why it happens is because institutional funds want to take advantage of the event, of the news event, of the news release that just came out, right? That's what the market wants to take advantage of. And then what you need to do at that time is you need to find a way to follow that money or stay away from that path. If you don't understand it, stay away. If you understand it, follow it, you make money from it, right? So, and also we talked about the strategies to trade that before, okay? You want to wait for the news to come out, then you want to follow it according to technical analysis. That would be the best approach all the time. But why do I refer to that? That's not what we're talking about this evening. I refer to that because first of all, you want to identify the trend, and when identifying the trend, you are looking for the money flow. Where is the money flowing towards? That's the purpose of the trend. That's why it's your friend. If you try to trade against the trend, what will happen is you will get crushed. It's like you are standing in front of a moving truck, a truck that's loaded up with heavy duty goods. And then you want to stand on the way of such a truck, or you stand in the way of a train, right? You can't do that. You get run over. That's the reason why your little money that you put in the market, your $1,000, your $2,000, cannot stand the market when it moves against you. So you don't want to stay you don't want to stay on the way of the market that is flowing in a different direction. You don't want to go against the flow. You want to go in the direction of the flow. So the first thing you do is we identify the trend. Where's the trend going? That tells us where we are going to be trading, on the direction in which we're going to be going. If we are in an uptrend, we are going to be looking for buy opportunities. We are looking for a pullback, then we'll buy. If we're in a if we're in a sell trend or a downtrend, we are looking for pullbacks, then we're going to sell. Right? If we're in a sideways trend, what we're looking for is a breakout up or down. So that's why breakouts is very, very important in the market, understanding breakouts and fake outs. Now, breakouts give us basically good opportunities for trading in either a new direction or a continuation of the previous direction. Let's say we're in an uptrend right now, and then after a while, price got stuck because liquidity slowed. Maybe price moves from the London session, New York session, all the way to the Asian session, and then during that Asian session, liquidity reduced, liquidity slowed. So when liquidity slows at that point, you will discover that a range is formed, a range is created. right? So when liquidity returns to the market, maybe the next morning, the London session opens, you will usually see a breakout of the previous range that was formed the previous night, right? So it could be a breakout in the current direction, in the current trend. Consolidation was formed, which is like a range, and then price breaks out again and then continues the uptrend. That's one scenario. Then another scenario is you are in a downtrend and price also forms a consolidation after coming down for a while and then breaks out and continues coming down, right? That's another one. Then you find that a price sometimes is not just moving either in an up or down direction. Now you find a sideways trend. What you are going to do, to get a sizable trade from a sideways trend, you need to wait for a breakout. It has to either break above or break below. Usually when it breaks above, it will form a new uptrend. When it breaks below, it forms a new downtrend, right? So breakouts are very important in that they give us good opportunities to actually enter good quality trades that we can ride for a substantial amount of pips, okay? But then there are times where those breakouts are not exactly breakouts, right? Because we have said it before that we follow the money, and then this money we're talking about following, who is this money with? All right, it's with institutional traders, hedge funds, these big guys who come into the market with billions of dollars. And then usually what happens is that they also have capacity to manipulate the market at certain times. Usually when the liquidity is not that much, right? So, and you usually see this early in the morning, or sometime when the market begins to slow down. So you will see price move massively, or it could even happen certain times during the news. You see it happen during the news. So you see price move in a particular direction. When you're on a lower time frame, you will think, oh, this is a breakout, price is going to buy. And then you see that it reverses. All right. So we are going to be looking through and understanding what breakouts are, what fakeouts are, and then also we'll get some tips on how to properly guard against fakeouts. Because what we want to do is we want to be able to get we want to be able to get good quality breakouts, and then we also want to avoid getting into fake outs. You see, so we want to understand how to get into good quality breakout trades, and then we want to understand also how to avoid entering into fake outs. Fake outs are like traps. You know, they are like traps. We want to avoid entering those traps. So that's what we're going to be discussing this evening. And also, by the end of this class, we'll also go into the charts and look at one or two scenarios where it played out, probably today or yesterday or something, so that we'll start to understand it. This is very important, guys. So first of all, breakouts. What are breakouts? So a breakout occurs when a currency pair's price moves beyond a key level of support or resistance. All right, so like I said before, first of all, you want to identify a trend when you come into the market. Second of all, you want to identify structures. You want to identify a support structure. You want to identify a resistance structure or a supply and demand structure. That's what you want to identify first, right? Or you want to use a trend line. Understand trend lines are also support and resistances. They are just like they are diagonal, while support and resistance most of the time are horizontal. So what you are looking for is, first of all, you want to identify a trend, then find quality support and resistance. Quality support and resistance. And we know that what we are looking for is when price is stuck within a support and resistance, that's what you call a trend. That's what you call a range. When price is stuck within a support and a resistance for a while, that's what you call a range. So what we are looking for is when price breaks out of that, comes out of that range, that's what we call a breakout. Okay? When price comes out of that range, that's what we call a breakout. So a breakout occurs when a currency pair's price moves beyond a certain key area, key support or resistance level. So breakouts are usually accompanied by an increase in volume, in trading volume, indicating a strong market trend. Now, that's the reason why you see sometimes you mark up certain zones, certain structures, and then non-farm payroll comes out, or FOMC happens, or some kind of rate event happens CPI happens, and then you see price just going through support and resistance as if they are not there. You see? So what usually happens at the time a particular news event, a volatile news event comes out, is that there's massive volatility in the market. There's massive volume in the market. Volatility is also known as volume. Volume is also known as volatility, right? So there's massive volatility in the market, and their structures are just broken. Support is broken, resistance is broken, as if they are not even existent, right? So that happens during news events. So breakouts are usually accompanied by an increase in trading volume, indicating a strong market trend. This is one reason why I say that when you are trading during the news or after the news, you should first of all wait for price to make a certain impulse move. All right? When price makes a certain impulse move during a news release, then you know that, okay, price is going in this direction. An example right now is that if you look at USD JPY right now, you will see it in Euro JPY too. You will see it, what I'm talking about now, USD JPY currently. You will see a massive sell candle. That happened at it actually happened 3 hours ago. That's by 4 p.m. Nigerian time, right? GMT +1. And what happened was the consumer confidence index that came out from the US. You will see that massive candle, and currently price is selling. USD JPY now is selling, Euro JPY is selling currently, right? Even though when we look at the entire structure, it's still a buy, the whole structure is still a buy scenario, right? It's still a buy trend, but this looks like right now like a pullback. But currently, what's leading to the pullback is what I'm explaining, right? Because we've been waiting for that pullback since the beginning of the week, since Monday, because that breakout for the buy happened on Friday. So we'll be waiting for that pullback to happen yesterday, today, just started happening this evening, right? So that's what happens when you see a breakout. Usually when news event happens, lots of volume come into the market and it leads to breakouts, okay? So number three, traders often look for breakouts as an opportunity to enter or exit trades, as they can signal a change in market direction. So this is for, if you're using breakouts to exit trades, you can use breakouts to enter a trade, right? You can wait for a breakout to happen. When a breakout happens, then what you do is you look for a pullback. You look for a pullback before you enter a trade, right? Now, if you need a breakout to exit a trade, that means that you are probably in a long-term trade. You are in a swing trade. For those who are swing traders who will be trading 1 week, 2 weeks, and one trade is running, right? So when you see a massive breakout somewhere, you are thinking, okay, maybe I need to take profit. Market is probably changing direction, right? So that's why breakouts, some people use breakouts in order to exit trades. When you are in a trade where you're targeting 300 pips, 400 pips, right? So that's what breakouts, some traders use it. And most of the time, you will not need to use a breakout to exit a trade if you're not a long-term trader, if you're not a swing trader who is targeting 2, 3, 4, 500 pips on a trade, right? But most of the time, we will always use breakouts to enter trades. We'll wait for a breakout to happen. Then what we'll do is we will then wait for a pullback. Then we'll now enter that trade, right? So 4, breakouts can occur in any direction. It can be upwards, it can be downwards, it can be sideways, and can be identified using technical analysis tools such as trend lines, moving averages, or chart patterns. Yes, so chart patterns, so chart patterns happen when we talk about market structure, right? When you come into the chart, you mark up your support, resistance levels, right? You begin to see the trend of the market moving in a particular direction. So when market reverses and does a breakout of one of the structures, which is a support or a resistance structure that you have drawn, then you really know that price is about to change direction, right? Price is changing direction right now, and then you know what you should do next. If you're in a trade, you probably want to exit that trade at that time. If you're not in a trade, you're probably positioning yourself to enter a trade at that time. So there are other tools like a moving average that you can use. A popular moving average is a 50 SMA, 50 simple moving average. Usually, a 50 simple moving average identifies a trend. It helps you with identifying a trend. So on certain time frames, when you see a simple moving average broken, when you say price break through a simple moving average, okay, in a very impulsive way. When I say impulse, I'm talking of really huge candles. When you see a huge candle form, right, that's what we call an impulse candle. An impulse candle usually leads to a change in direction. It gives you a new direction. It could be a continuation of a previous direction, or it could be a change in direction, right? If you want to see what I'm talking about now, go check USD, Euro. Of course, you know these things, but if you are still not, if you want to see it happening today, Euro JPY, USD JPY right now, you will see an impulse candle, which is why the sell is happening currently, right? So that's what you see all the time. So moving average, a 50 EMA SMA is a good one that you can use to see a change in direction. You see, so when that 50 EMA is SMA is broken, you will usually see price move in the direction of that break. So if it breaks out to the upside, breaks out, you see the moving average is broken to the upside, you see price usually continue buying. When price is broken to the downside, you will see that price market will continue downwards, at least for a certain period of time, right? So that's what we are saying here. So let's look at fake outs. A fake out occurs when a currency pair's price briefly moves beyond a key level of support and resistance, but then quickly retraces back into the range. So we're going to see this very soon in the chart. So you will see price, you will draw a structure like a resistance structure or a support structure, and then you see price go through it heavily, right? When price goes through, you'll be like, wow, price is going to start buying. And then maybe you are watching on a lower time frame. Someone was asking me some time ago, it was like, what time frame do I trade from? And I said I trade on certain time frame. I trade on mostly on a 1 hour time frame and all that. He was like, okay, is it that you shouldn't trade on a lower time frame? I was like, no. There are some pairs where you can actually trade on lower time frames. The reason why I trade the way I trade right now is because I realized that there's usually fake out for the currencies that I trade. They are usually fake out on lower time frames. Lower time frame for me is like 15 minutes, 5 minutes, 15 minutes, 30 minutes. Most of the time you will see fake outs in those, you will see fake outs in those time frames. But also, there are also times where I could miss a trade because I'm not watching the lower time frame, right? There's a time I could also miss a trade because I'm not watching a lower time frame. But the truth is, missing a trade is not as bad as losing a trade, right? Missing a trade is not as bad as losing a trade. Losing a trade is the one that you feel bad, especially when you know that you could have, hey, I could have not done this, or I could have not entered this trade, right? So it's best to have those rules that keep you where you should be. Not that you may not make a losing trade, but even when you make a losing trade, you are consistent in your approach to the market so that you are able to recover your losses if you make any losing trade, right? So fake out occurs when a currency pair's price briefly moves beyond a key level of support or resistance, then quickly retraces back into the range. We will look at this on the chart when we are done with this. So 2, fake out can be caused by market manipulation, false signals from technical analysis tools, or sudden news events that cause price to spike that causes temporary spikes in price. Now, you will notice this many times when you see that a particular news event is released. It could be non-farm payroll, it could be FOMC, it could be CPI, it could be whatever news event that's released. And you will see that price will move in a particular direction first. Okay, it could move in a sell direction and you think, oh, price is going to sell. And then while you are entering that sell, it reverses and starts buying. That's a fake out. And what's happening at that time is that a particular news event came out, and the market's interpretation of it at the moment that it came out was sell. But then in a moment of time, the market reversed because most of the money flowing into that currency at that time felt that the news that came out should be a buy signal, right? So it's always important to realize why this happens most of the time when news comes out is because it's usually important to realize that it is not the news that comes out most of the time that moves the market. It is the interpretation of the news of the events that just got released. So if the market something can happen in the market. Let's say FOMC happens and the Federal Reserve decides to increase interest rates by 0.25%, rather than, and then previously they increased it by 0.5%. For example, let's use this as an example. The market can take that as either bullish or bearish, right? So at that time, that's the reason why you as a trader, you as a retail trader, your best bet most of the time is just to hold on and watch for maybe 30 minutes to an hour. Because you don't know, the market might interpret. There are times where you see commentators on like Bloomberg, and a news comes out, and then they are expecting the market to buy because of that news, and then the market sells. And they're like, why did the market sell? Now they start to wonder, how is the market interpreting this particular news? So you see it go to sell first, then it comes to buy. All at the same time. It could be like within 5 minutes or so that happens. There was a news event that came out, I think about 2 weeks ago, so a few weeks ago, and I said in the group that there was no way you could have traded. I think it was last CPI. I said in the group that there was no way you could have traded that event on a fundamental basis without you without you losing money. If you bought, you will see that it bought and sold all within a few minutes. He bought and sold, and then the candle closed as a doji. You see? So if you bought that trade, you would have lost money. If you sold it, you would have lost money. That's the reason why the only thing you would have done at that time is just stand off, stay off the market at that time. That was the only way you would have not gotten into that fake out. Okay, so fake outs usually happen in the market during news events because of market interpretation, the way the market interpreted that news at that time, right? Because the way the market interpreted it at that time, that's what led to that particular fake out. Which is why one caution you need to have as a trader is to make sure that, except you are a professional news trader, you want to make sure that you are outside of the news, outside of the market when a news event is happening, right? Because sometimes it can go your way, and you're like, oh, I made money from this. But then you may want to try the next time and it burns you, because you don't have you cannot know exactly what is going to happen, right? That's why we trade technical analysis. Technical analysis is how we can actually predict the market. Use the data we are seeing, the candle formation, the candle patterns, right? We're using the candle patterns, price action, market structure to analyze the market and then take positions based on what the market is telling us. But news event is a bit different from that, right? So that's what this is telling us right now. It's telling us manipulation. Market manipulation can happen, right? It could be during times of low market volatility and some big monies will usually come in. This is one reason why a lot of traders are advised, especially who are not experienced traders, are advised to not trade during times of holiday, worldwide holiday, like the kind you find during the Christmas break and stuff like that. Because those are the times where huge money market makers would usually manipulate the markets. The reason is most banks are closed. Most banks are not in business at that time. And then those who are trading are usually retail traders. So these guys can come in with big money, with billions of dollars, and move the market any way they want. Because understand something, every time your stop loss is closed, somebody took profit on your money. That's how it is. Anytime your trade hits stop loss, somebody else pushed that trade to your stop loss and made money from that. That's actually what happened, right? So you want to make sure that you are not in the market during those times of low market volatility. That's when manipulations can happen, right? So traders who fall, that's number 3 now, traders who fall for a fake out may enter or exit a trade at the wrong time, resulting in losses or missed opportunities, right? It could be that price is at a particular resistance and the thing just moves past it and you're like, oh, I know that this trade is going to buy. It's at a resistance. Price just went through that resistance and you're like, oh, I know this thing is going to buy. Let me jump in for a buy quickly. And you jump in for a buy and then the market reverses like that. And then from there puts you in a very massive drawdown from there. And then the only thing you can do on that trade is basically just bail out, close and leave. Because there's no way you can wait for that trade to reverse. because most likely it's not going in that direction. It was just a fake out, and you just got trapped in a fake out, right? So you want to be able to exit that trade quickly so that you don't multiply the losses you make on that trade, and then position yourself to take the next trade, which is likely going to be profitable for you. Okay, that's what happens where some people now enter a trade. Some traders enter a trade like that, and they're like, oh, let me hold on. Price is likely to come back there. Most of the time, if it doesn't come back, not that the market may not come back there, but the market may come back there at a time that is different from the time you are expecting. If it's a buy, the market may sell massively before buying. And then all the time it's selling massively, your heart is shaking because you are in a serious drawdown. So when you are in a little drawdown, you want to exit that trade in a little loss and move on to the next trade that can recover your lost trade and make you profit, right? So the fourth one is to avoid fake out. Traders may use confirmation indicators such as oscillators, momentum indicators, candle patterns, or to validate a breakout before entering a trade. So using patterns is the most reliable, and also trading on certain time frames. Trading on certain time frames can help depending on the instrument you're trading, right? So that's one of the reasons why if you're trading any instrument that you're trading, you want to make sure you have an understanding of how that instrument works, right? That's the reason why that's why you see most professional traders do not trade so many different instruments at the same time. They trade gold, silver, everything, NASDAQ, Bitcoin, Ethereum. They don't trade like that. The reason they don't trade like that is because it's difficult to follow the journey of an instrument, follow all the news events, everything that happens with an instrument, and follow 20 of them, follow 25 of them. You cannot get it, you won't get it right. Right? And the truth is, it's not the number of instruments you're following that makes you make money. That doesn't mean you're going to make money because you're trading so many different things. When you trade a few amount of instruments, you are able to know them. You're able to know that, okay, for this particular instrument, I should not trade it on 15 minutes, right? For this other instrument, I should trade it mostly on 4 hours. For this instrument, I think that I can always trade it on 15 minutes. You will know what you are trading, and then you'll be able to know exactly what candle patterns work best for that particular trade, what time frames are better for you to actually make profit on that trade, right? So now these are tips for trading breakouts and avoid fake outs. Number one, look for clear and strong support or resistance level before trading. So, like I said, I'll back up a little bit. First of all, you come into the market, you want to understand the trend. What is the trend of the market? Is it a buy trend, or is it a sell trend, or is it a sideways trend, otherwise known as a range? That's the first thing you want to see. Now, when you have done that, you then want to find out, okay, if it's an uptrend, it means I should be looking for buy opportunities. So if I'm looking for buy opportunities, I need to get my support and resistance and wait for a breakout of my resistance, because when price breaks out of my resistance, I know that the continuation of the buy trade has started. That's when I'll be looking for a buy, right? Yes, because I'm in an uptrend. I'm looking for a buy. So what's my buy opportunity, right? I'm waiting for price to hit my trend line, or I'm waiting for price to break out of a resistance so that I can continue trading. And in the case that doesn't even happen, if price now drops and then breaks a support, you know that probably there's a change in trend. Probably there's going to be a change in trend, right? So that's the first thing you want to do. Yeah. Identify strong support and resistance, and then you want to wait for them to break out in a proper way, okay? For me, for example, there are instruments I trade, I draw my support, I get my support and resistance correct, and then what I'm waiting for is a breakout on like 1 hour chart. I'm not waiting for a breakout on a 15-minute chart, because I know that that's going to be a fake out. Most likely that's going to be a fake out. But I'm waiting for it to break out maybe on a 1 hour chart. When I see a breakout on a 1 hour, I'm good. When I see a breakout on a 4 hour, I'm good. I know that, okay, this is going to be good. As long as there's no news event happening soon, as long as there's no news event happening at the time of the pullback, When price is pulling back and there's no news event, I'm sure that, okay, price is likely to do exactly what I expect it to do. Once I see a breakout on a 1 hour or a 4 hour. But if I go on 15 minutes, I know that I can easily get fake outs on 15 minutes. So that's very important, right? So number 2, monitor trading volume to confirm the strength of a breakout. Now, how do you monitor trading volume? You know trading volume by the size of a candle. Is it impulse? Is it an impulse move? Or is not an impulse move? I said it before, when you see a massive candle, usually those kind of candles that happen when the news event happens, right? When you see that massive candle, that's what you call that's what they call you call an impulse candle. That also confirms to you the kind of volume in the markets. Is it massive volume? Is it huge volume? Is it low level volume? That's what you're looking for in the market. What is the size of the volume in the market? You see, so when the volume in the market, which is the volatility in the market, which is the size of the candle, tells you where market is likely going next. Happens during the news, you guys is likely changing that. I may have to stay on the sidelines and watch for it to give me a confirmation, okay, before I enter for a sell. Most likely that's a change in direction. So that's how you monitor trading volume. What is the size of the candle? Is there a news event? All of those things, you put them together. Sometimes the news event doesn't move the market. Most times the news event will move the market, right? Yeah. So that's how you monitor volume in the markets, right? So that also tells you whenever you see a price breaks through a support or a resistance with such a massive candle, especially maybe during news events, you know that price is going in the direction of the breakout. Price is going in that direction of the breakout, right? So the next thing is use multiple technical analysis to confirm breakouts and avoid fake outs. The most important one I can tell you guys, the most important one is your time frame and candle patterns. The most important thing you can use is time frame. What time frame are you trading for this particular instrument? That's number 1. Number 2, candle pattern. How is the candle pattern formation? Then also you can use indicators like the moving average I talked about earlier. Moving average 50 SMA. 50 SMA is one I use, and I kind of like it. It's not perfect, but I just use it in conjunction with price action, with market and market structure and all that. I just use it whenever I see it break. When I see price break out of it, I just add it as a confirmation, an extra confirmation to what I already do. I personally may not even need to use it, but sometimes you will see it play out in the market and you're like, okay, this is good. It's just a good addition, right? Yeah. So wait for confirmation from confirmation indicators before entering a trade. So you want to also make sure now when we say when we say indicators here, indicators doesn't necessarily mean stochastic, MACD, and the rest of them. No, your own indicator is something that you're waiting for. What are you waiting for before you enter a trade? What have you determined ahead of time that this is what I'm going to trade? This is what I will see in order to trade. That's what an indicator is, definitely. Of course, you can use any other indicator, but I'm saying that in case you are not using you're not using any indicator and you're just using price action to monitor the market, what you want to wait for is what exactly have you determined ahead of time that this is what I'm going to see before I enter the market, right? So that's what you wait for. You wait for that, and when you see that, then you enter the market. You enter for a buy or a sell, right? So keep a close eye on news events that can trigger sudden price movement and fake outs. So this is very, very important. This is so important that any news, the truth is, you should not underestimate any news event. Any news event can move the market. In fact, this evening, the consumer sentiment index that came out this evening, I personally was behind my mind. I wasn't even thinking it was going to move the market, right? But it was a high impact event. The news calendar showed that it was a high impact event. But in my mind, I wasn't so sure it was going to move the market, right? I was like, okay, let's see how it moves the market, because that's just the way it is. You're going to have to monitor it and watch it because you never can tell. Sometimes non-farm payroll will not move the market. Sometimes FOMC will not move the market, but sometimes one little news, retail sales, or one little thing will just move the market in a very wild way. And the reason is because of the data itself and how it plays into the current state of the economy. The data and how it plays into the current state of the economy. For example, you notice that for the past few years, there have been issues of the war in Ukraine, there have been issues of inflation, there have been issues of there have been a lot of issues. COVID-19 happened, all of these things happened. But now, because of the way the economy is now, especially in the United States, any news event that has to do with employment, that has to do with inflation, has a tendency to move the market, right? Anything that has to do with the strength of the consumer are people spending more money? Are people spending less money? Every such data right now has a tendency to move the market because it tells traders what is happening in the economy. So if there's consumer sentiment is low, basically what the news that came out this evening was that consumer sentiment was actually lower than expected. And then the dollar started to make a sell. It started to drop. It became bearish, right? And the reason for that is that consumer sentiment is telling the market that, oh, it looks as if there's a little bit of moderation in the strength of the consumer in the US consumer, because people have been spending money, buying things, spending money, and there's been this issue about inflation, job numbers, all of that's coming together. So when the market sees that there's a weakness in the strength in the consumer confidence, it tells them that, okay, something is happening in the market. Because from next week, there's going to be all these numbers that are going to be released. Next week, non-farm payroll is going to be released next week, and then after that, you're going to have the CPI, then you're going to have Joe's job report, then you're going to have FOMC, or anything that happens right now. The market reads meanings into it, reads a lot of meanings into it as to what is likely to follow this. Okay, this happened. What is likely to follow this? So all of that is what we try to follow as traders, so that we'll know the direction the market is going. We can know what is likely to happen from an event that has already happened. So something happens now, a news event is released. We can have an idea of what the next event is likely to look like based on this one that just got released, right? So that's what that's why we have to keep an eye. So it says keep a close eye on the news event that can trigger sudden price movements and fake outs, right? And then it doesn't only trigger fake outs, it also triggers breakouts. So there's opportunity in it, and also being able to watch it to make sure that we don't get trapped in a fake out, right? All right, so let's quickly look at one scenario of a breakout, fake out situation. Okay. All right, so look at this. Okay, so look at this area right now. You will see that this is what you consider this right now as a resistance. Now, resistances are basically a zone, but I'm just using it as an example. This is like a line. You see a resistance line there, right? Okay, so now let's go to, this is USD JPY. Let's go to a lower time frame, okay? So when you go to this lower time frame, depending on how you've been trading, you could think that, you could think that this actually was a breakout. So you might think that, oh, this is breaking out here, or this broke out. And then you may feel like, okay, I'm going to buy from here. Once price gets here, I'm going to start buying. Let it keep going up. That's what you might think. But when you go to a lower time frame, when you go to a higher time frame, sorry, like 1 hour, you will discover that there was nothing like a breakout there at all. Can you see this? There was nothing like a breakout there. It was just you just see wicks of candles there, wicks, nothing like a breakout. Now, this doesn't happen all the time with all instruments. Like I said, this is one instrument I trade. It's one instrument I trade, and I make sure I don't trade it on lower time frames. I make sure I don't trade it on lower time frames. So this is why, that's how you want to make sure, first of all, with instrument you are trading, have you been able to study where fake outs happen? What kind of breakouts happen? There was a time when I first of all started trading this instrument, I will trade it on the 15 minutes. I'll try to get trades on the 15 minutes. Sometimes I'll get it right. Sometimes it will just happen like this, and I'm trying to get in, because most of the time, why we traders want to get into trades on lower time frame is because we want to get in at a very good entry. Oh, I don't want to miss the entry. I want to get in at a very good entry, because when you get in at a good entry, it also helps your stop loss. So you get a very good entry, your stop loss is tighter. So you are able to ride the market very massively, right? But then you also want to make sure that the instrument you are trading, you are careful with it to know that you're not getting into fake outs. You know, make sure you're not getting into fake outs by understanding how that instrument works. Okay, when you understand how that instrument works, then you'll be able to know. But in this case now, for example, look at this. You see that you try to enter for a buy here. What happens? You see a massive bearish engulfing. So when you see this bearish engulfing, what's that telling you? It's telling you that this is a fake out. So if you were already entering this trade, maybe you entered with a pending order for a buy, you expected price to start buying from here. You expected price to start buying from here. Hold on. Sorry. So if you expected it to start buying from here, but then you see a candle, a bearish engulfing like that, that shows you that this is a fake out. And then you would have, all you just need to do is close this trade and get out of it. Close this trade, but you would have closed it on a small loss. But if you use a higher time frame like 1 hour, you will not even get into this trade at all, which means that you will not even make that loss at all. Right? So this is an example of how you can avoid trading and how you can avoid trading a fake out, or you could get out of a fake out very quickly and take a very little loss and get out of that fake out and be able to get into a better trade the next time, right? All right, so we have just a few minutes left. I would like us to ask some questions. I'd like us to ask some